Breaking news out of Toronto. And what is unfolding right now is sending shockwaves through global financial markets, not because of a stock crash or a banking collapse, but because something far more fundamental is starting to fail. The financial plumbing that underpins the largest bilateral trade relationship on Earth is beginning to seize up. Multiple Canadian banks have started restricting US dollar transactions. Currency exchange services are being quietly limited. Cross-border financial operations that move trillions of dollars every year are slowing to a crawl. This is not a rumor. It is not speculation. It is happening in real time, branch by branch, institution by institution. To understand the scale of this moment, you need to understand what is at stake. The United States and Canada trade roughly $773 billion in goods and services every year. That works out to about $2.7 billion crossing the border every single day. That flow depends on something most people never think about. Frictionless access to US dollars inside the Canadian financial system. Canadian businesses get paid in dollars. American tourists need currency exchange. Retirees split their lives between countries. Manufacturers settle invoices. Energy flows are priced. All of it depends on banks being willing to touch US currency without fearing regulatory punishment. And right now, that willingness is evaporating. Starting around December 20th, several major Canadian banks, including TD, RBC, and Scotiabank, began implementing restrictions on US dollar cash services. Customers walking into branches were met with notices citing temporary limitations and regulatory compliance requirements. At first glance, it looked routine. A technical issue. A short-term adjustment. It wasn't. 3 days later, on December 23rd, the Canadian Bankers Association issued an emergency advisory to its member institutions. The language was careful, but the message was clear. Cross-border US dollar transactions now carry elevated compliance risk. Translation: banks are afraid of violating US financial regulations, afraid of fines that can reach into the hundreds of millions, afraid of being caught between two regulatory systems that no longer align. This crisis did not start in Canada. It started in Washington. On December 2nd, the U.S. Treasury's Financial Crimes Enforcement Network issued new guidance tightening requirements around cross-border currency movements. Transactions over $10,000 now require enhanced due diligence. That sounds reasonable on paper. In practice, it changes everything. Under the new framework, banks must verify not just who is making a transaction, but who ultimately controls the money. That means tracing beneficial ownership across borders, legal systems, and documentation standards. What is straightforward inside one country becomes exponentially complex when money moves between two. Imagine you are a compliance officer at a Canadian bank. A business owner walks in with $25,000 in U.S. cash earned from legitimate sales at a trade show in Michigan. Under the old rules, this was routine. Verify the business, file the report, process the deposit. Under the new guidance, you now face a nightmare. You are expected to verify the origin of every dollar, identify ultimate beneficiaries, check sanctions lists, document the full chain of custody. If you get it wrong, you are personally exposing your institution to massive penalties imposed by a foreign regulator. At that point, the economics stop making sense. So banks did what banks always do when risk becomes unbounded. They pulled back. They restricted services. They slowed processing. In some cases, they simply stopped accepting US dollar transactions altogether. Not because the money is dirty, not because customers did anything wrong, but because the compliance cost now exceeds the value of serving them. And here is the irony. These rules were designed to stop money laundering and illicit finance. But sophisticated criminals do not rely on retail bank branches and documented transfers. They route funds through crypto, shell entities, and opaque jurisdictions. The people getting locked out are the compliant ones. We have seen this movie before. In 2013, when the U.S. implemented FATCA, foreign banks around the world began closing accounts held by American citizens. Not because those citizens were criminals, but because the reporting burden was too high. Law-abiding people were cut off from basic banking services overnight. What is happening now is the same pattern, but on a far larger scale. This is not about a niche group of expatriates. This is about the financial backbone of North American trade. When banks stop facilitating currency exchange, trade does not stop immediately. It slows, it clogs, it becomes inefficient. Then it becomes unviable. And once that happens, relationships begin to fracture. This is not a market crash, this is worse. It is a structural failure introduced by regulation, and the consequences are only beginning to surface. When financial systems start to break down, the damage never appears where policymakers expect it to. It doesn't begin on trading floors or in government offices. It begins quietly, with missed payments, delayed wires, and ordinary people discovering that systems they relied on for decades no longer work. For Canadian businesses engaged in cross-border trade, this situation is not theoretical. It is operational chaos unfolding in real time. Take a mid-sized manufacturing firm in Ontario. Not a multinational giant. A real company employing a few hundred workers, supplying auto parts to U.S. manufacturers in Michigan and Ohio. 60% of its revenue is paid in U.S. dollars. Those dollars need to be converted to Canadian currency to cover payroll, rent, energy, and domestic suppliers. Under normal conditions, that conversion happens seamlessly. Same day. Predictable fees, stable cash flow. Now, banks are telling these firms that large U.S. dollar transfers require enhanced documentation and extended compliance review. Processing times have stretched from hours to a week or more. In manufacturing, a week can be fatal. Suppliers don't wait. Workers expect paychecks. Contracts carry penalties. For companies operating on thin margins, delayed settlement is not an inconvenience. It is a liquidity crisis. Multiply that across thousands of firms, and the scale becomes alarming. In 2024 alone, Canadian exports to the United States totaled roughly $447 billion. Even partial disruption to those payment flows puts tens of billions at risk. Not because demand disappeared, but because the financial rails can no longer support the trade. But businesses are only one side of this story. There is another group being hit even harder, and almost no one in Washington is talking about them. Canadian retirees. Roughly 1 million Canadians spend part of the year in the United States. They own or rent homes. They pay rent, utilities, insurance, medical expenses. Many of them rely on routine monthly transfers from Canadian banks into U.S. accounts. Now those transfers are being delayed, flagged, or rejected outright. Imagine being 72 years old, living on a fixed income, and discovering that your bank can no longer guarantee your rent payment will arrive on time. Not because you did anything wrong, not because your funds are suspicious, but because your bank decided the compliance risk was too high. This is not hypothetical. It is already happening, and it reveals a deeper truth about how regulatory shocks spread. They hit people least able to absorb disruption first. Retirees, small businesses, service workers, not hedge funds, not multinationals with treasury departments and legal teams. American businesses are being pulled into this too. Restaurants in border states that source produce from Canadian farms, construction firms that rely on Canadian aluminum or lumber, retailers that serve Canadian tourists. All of these operations depend on smooth cross-border settlement. When payments slow, supply chains tighten. When supply chains tighten, prices rise or quality drops. Tourism has become another pressure point. Canada welcomed more than 20 million American visitors in 2024. Americans visiting Canada now face currency exchange rates far worse than normal. Independent exchange operators are charging premiums of 10 to 12% because they cannot reliably source U.S. dollars. That functions like a hidden tax on travel. Families pay hundreds of dollars more simply to access their own money in another currency. Some still travel. Others quietly change plans. And this is where the damage compounds. Tourism is not just flights and hotels. It is restaurants, retail, entertainment, seasonal jobs. When visitors hesitate, entire local economies feel it. Markets have noticed. Canadian bank stocks have fallen sharply as investors price in regulatory risk and lost revenue. Shares of major institutions dropped several percentage points in days. That is not a panic sell-off. That is a recalibration, a recognition that cross-border banking is becoming structurally riskier. And behind all of this is a geopolitical tension that few policymakers want to confront. Financial integration has been the foundation of U.S.-Canada cooperation for generations. Trade agreements, defense coordination, energy flows all assume that money can move freely. When that assumption breaks, everything downstream becomes unstable. The most dangerous part of this crisis is that it does not feel dramatic. There is no single moment of collapse, no emergency vote, no bank run, just gradual withdrawal. Risk committees tightening rules, services quietly disappearing. And once banks adapt to operating without these services, they don't rush to restore them. Risk aversion hardens into policy. This is how structural damage becomes permanent. What makes this crisis genuinely dangerous isn't the immediate disruption, it's the adaptation that follows. Financial systems don't collapse all at once. They reroute, and once new routes form, they rarely disappear. When banks restrict dollar services, people do not stop moving money. They find other ways. This is where regulators consistently get it wrong. If a Canadian exporter can't reliably convert U.S. dollars through a regulated bank, they don't shut down their business. They explore alternatives, offshore accounts, cryptocurrency intermediaries, informal settlement networks, workarounds that exist precisely because modern commerce refuses to stop. Every one of those alternatives is less transparent than the banking system regulators are trying to protect. This is the central paradox of aggressive compliance enforcement. When compliance becomes more expensive than participation, institutions exit. And when institutions exit, activity moves into darker corners of the system where oversight is weaker, not stronger. Former Treasury officials have been warning about this for years. Over-enforcement doesn't eliminate risk, it redistributes it. The comparison to the Foreign Account Tax Compliance Act is instructive. When FATCA went into effect, foreign banks didn't suddenly become better at reporting U.S. citizens. Many simply stopped serving them altogether. Law-abiding people were cut off, while sophisticated actors adapted. The difference now is scale. The U.S.-Canada financial relationship isn't niche. It underpins nearly $800 billion in annual trade. It supports energy markets, defense manufacturing, agriculture, transportation, and services. If the plumbing weakens, the pressure spreads outward. And that is exactly what analysts are now watching. The longer banks maintain these restrictions, the more businesses are forced to redesign their operations around reduced dollar access. Contracts are rewritten. Payment terms change. Suppliers diversify away from U.S. settlement systems. Once those adjustments are made, reversing them is not automatic. This is how decoupling begins, not through ideology, but through risk management. There is also a reputational effect that Washington has failed to account for. Foreign banks are watching this closely, not just in Canada, but in Europe, Asia, and Latin America. The question they are asking is simple. If routine dollar transactions with America's closest ally now carry this level of enforcement risk, what happens when political tensions rise with less friendly partners? U.S. correspondent banking relationships depend on trust. Trust that rules are stable. Trust that enforcement is proportional. Trust that yesterday's compliant transaction won't become tomorrow's liability. When that trust erodes, banks quietly reduce exposure. They limit dollar holdings. They explore alternative clearing systems. They hedge against future regulatory shocks. None of this requires a coordinated move away from the dollar. It happens incrementally, risk by risk, balance sheet by balance sheet. This is why central bankers are uneasy. The dollar's global role is not guaranteed by law. It is sustained by convenience and confidence. The moment using dollars becomes operationally hazardous, incentives shift. We've seen this movie before: sanctions regimes, asset freezes, extraterritorial enforcement. Each step seems justified in isolation. Together, they accelerate the search for alternatives. Chinese yuan clearing networks, European payment rails, bilateral settlement agreements that bypass U.S. intermediaries. These systems don't replace the dollar overnight. They don't need to. They just need to exist. And once they exist, the dollar loses something far more valuable than market share. It loses indispensability. Politically, the response has been telling. The U.S. Treasury's public statements have been vague. Monitoring the situation, engaging with counterparts. No acknowledgement of systemic risk. No timeline for clarification. No safe harbor for routine transactions. Congress is absent. It's a holiday period. Financial plumbing crises don't generate viral outrage. There are no angry crowds, no dramatic headlines, just quiet damage accumulating beneath the surface. In Canada, public sentiment is shifting fast. Polls now show a strong majority of Canadians view this disruption as the result of American regulatory overreach. Not market failure, not criminal activity, government action. That perception matters, because trust, once lost, does not reset when regulations change. It lingers. It reshapes behavior. Businesses remember who made their operations fragile. Retirees remember who put their savings at risk. Banks remember which jurisdictions create asymmetric liability. And this is where Washington's greatest miscalculation becomes clear. The enforcement logic assumes compliance pressure is temporary pain that forces alignment. But alignment only works when participants believe cooperation restores normalcy. Here, normalcy itself feels broken. What regulators may have unintentionally demonstrated is that financial integration with the United States carries unpredictable political risk. That is not a message any reserve currency issuer wants to send. Because once institutions begin pricing that risk permanently, the system does not snap back. It rebalances, quietly, persistently, and often irreversibly.